Hey, what's going on YouTube? We're going to go through Coupang, ticker symbol CPNG. I do have a little bit of a bias on this company. I do own shares. They had just reported their earnings a couple days ago on May 8th. They missed their EPS but beat on revenue. And with that report, company went from about 23.50 down to about 21.50 per share. Since then, it has recovered slightly throughout the week. But year to date, the company is still up about 39%. And over the course of 1 year is up about 35.5%. So they had a couple little, I would say a pro and a con in the last quarter for news. And I would consider their con to be their acquisition of Farfetch. Now, this is my personal opinion. What this company it's like a luxury designer clothing company. And they've got, for instance, this shirt right here. $645 for this shirt, and you've got this little, pair of pants for 1,400 bucks, a pair of jeans here for 1,000 bucks. Like, I think for my personal just opinion on this is that I think this is just, I don't know. I don't see how this is going to be very profitable. Maybe it will be just because how many people can actually afford a $700 t-shirt here? I mean, I think this is a little bit of a not a great acquisition in my opinion. Maybe it'll turn out to be something fantastic for the company. They'll see significant profits, but one of the reasons why earnings were actually not as great as expectations is because of this acquisition. At least that's what they're blaming it on. So we'll have to see what happens with this. We'll keep an eye on it, see if this actually turns into something good for the company. But again, you look at a Swan shirt for 1,300 bucks, like I don't know, I'd rather buy my $60 Under Armour sweatshirts and call it a day. Even those to me I feel like are expensive. So the pro in the most recent quarter though was they raised their Rocket Wow subscription price by 58%. And their subscription price used to be $3.06 or $3.60 per subscription. And with that increase, they're now $5.70 per subscription. So even though they bumped up their subscription by 58%, sounds significant, right? But I don't think anybody is going to care that it went from 360 to $5.70, 20 or $2.10 increase. I bet nobody's even going to notice, that all of a sudden it's $5.70 per month on their subscription service. So can't imagine anybody's going to cancel their subscription over that. I bet they could probably even double their subscription at least one more time. They could probably get it up to 10 bucks per share, maybe, or per month, per person, or per household, or however they do it. I bet they could do that and still maintain their same client base. I bet maybe see a couple cancellations in there, but probably nothing significant. So very bullish to see him do that. I'd like to see him do it more. Because I think that having that subscription model is definitely going to show up in their revenues. And just based on this right now, increasing their subscription revenues by 58%, that's going to hit and increase their top and bottom line and probably even increase their cash flows going forward. So very bullish. I like that a lot. I hope they can do it again, maybe in the future, at least plan for some more price increases just because it's still so cheap. It's only $5.70 per subscription. I think there's plenty of room to grow on that side of things. Now let's jump into the financials. We're over here on our valuation spreadsheet. This one just kind of gives us an idea of the history of the company to see how it has performed over time. These numbers for the trailing 12 months are not accurate yet because they just reported earnings. These are not updated yet. So we're basically just going to be looking at up till 2023 numbers. Those will be the most accurate for right now for what we're looking at. Our revenue, gross profit, net income, all three trending higher. Revenue's growing rapidly. Gross profit's growing pretty steadily as well. Our net incomes recently have just turned into profitable territory. And then you increase your WOW subscription there. I think that's going to help catapult net incomes even a little bit higher. At least it should. So because you're just increasing what you're already charging people, you're just adding 58% to that. Should be pretty profitable going forward. Gross margins sitting at about 4.1%. Historically have done significantly better. I think a little bit of that has to do with maybe some acquisition costs and stuff like that. So we'll have to keep an eye on that to see if they can get that back to 20% or more. Net margins though sitting at 6.3%, best net margins they've had to date. So doing good there. Come down here to cash, short-term debt. The company does, they've got more debt, more short-term debt than cash, but we can see that cash is keeping up with our debt. We're not seeing cash dwindling, and we're not seeing debt grow out of control. So they're in control of both by the looks of it, and it looks to be pretty consistent there, which is good to see. Same thing with cash to total liabilities. Cash is growing, total liabilities is growing as of lately, but I would say not at a ridiculously quick rate. So we'll have to keep an eye on that too. But overall, looks pretty good. Then we come over here to net income to free cash flows. We can see positive free cash flows, positive net incomes for the last, trailing 12 months and 2023. So starting to see this company start turn into positive territory. I think this company has a pretty good outlook for it, at least for the short term. And we can see share count dilution, not getting diluted. So pretty consistent at for many years now. We've seen it sitting in this range. So not getting diluted as shareholders either. So that is very good. And we can see capital expenditures growing pretty rapidly, but starting to level off the last few 3-4 years there. So also pretty good. So overall financials historically looking pretty good, especially for a company that's trying to grow and make something of itself. So I'm pretty impressed. I like it, and that is why I own some of this stock. Now over to the 10Q, the most recent report that came out just a couple days ago. We're on our income statement. We got revenues here. We can see the biggest increase was our other revenue, slightly contributed from Farfetch acquisition. That's why we're seeing revenues up. But overall, it is pretty cool to see that they're up 100% year over year, over 100% year over year. And obviously, this is not even including the 58% increase of their subscription services, which is categorized in other revenue as well. So we'll see another uptick in other revenue this next quarter as well. So that'll be pretty cool. That'll be nice to see. We should see this increase, about 50 something percent. So then down here to costs, we can see, actually going back up to revenue, we can see revenues are up 18.5%, but costs are up 20%. Again, we can see the biggest, not the biggest, but one of the concerning ones would be this. Our SG&A cost is up about 600 some million dollars. Again, that's probably from the acquisition. So if you take your total net revenues of $7.1 billion minus off your operating costs and expenses, you're left with $59 million, and you got to take off income taxes. And now you're left with negative net income for the quarter. This time last year, we were positive. So we're just kind of sitting there teetering between positive and negative territory. So we're right on the line. And hopefully with their subscription services, we'll start to see this thing consistently hit above positive or above negative territory for net incomes. So down to the balance sheet, we got cash equivalents of $5.2 billion quarter over quarter, pretty flat. And we come down here, we carry over our $5.2 billion in cash. We can see we got $7.4 billion in short-term debt. We subtract off our debt. That leaves us with about $2 billion in, net negative cash. But one of the main contributors to our overall liabilities is our accounts payable, which is, the vendors and the suppliers that we have to pay. But this is more of that retail structured business. So they're going to constantly, it's going to be like a revolving door of product coming in, them having to pay their suppliers and whatnot. So it's kind of part of the business. That's how it's going to operate. It's always going to have accounts payable. It's going to continue to grow over time. And that's just going to be the way it is. So I kind of look past that a little bit when it comes to these retail businesses. So when you do, or if you do that, that leaves you with $2 billion in overall short-term liabilities, and you've got plenty of cash to cover all those short-term liabilities. So now to cash flows, we got our $24 million loss of net income right here on the top line. We come down here through all the cash that flowed in and out of the business. We've got stock-based compensation of $88 million. Normally, that's a pretty nominal number, but in this instance, when you're teetering on break even, that is a pretty impactful number at $88 million. So we're seeing that carry over to our cash flows, which is helping prop up our cash flows. Not necessarily a positive thing, but obviously then it does provide cash to be held within the company, and then they can use that cash going forward. So overall, we got positive cash flows of $212 million. We minus off our capital expenditures of $107 million, which leaves us with $105 million of free cash flow in this particular quarter. which annualizes out to be about $400-ish million in positive free cash flows at this current rate. So overall, all the financials look respectable. Again, the far-fetched thing throws a little bit of a wrench in everything, but I think we'll start to see those kind of iron out and see how things perform going forward, at least for the next couple quarters, to get a better understanding of how this is how that's going to impact the overall revenues and financials as a whole. So back to our valuation spreadsheet, we're going to look at comps. We have Amazon and Baba that I plugged in here for comparables. I feel like there's similar companies. I think Coupang is trying to mimic Amazon based on how their business is structured. That's just my assumption on that. But we come down here and take a look at the comparison between the three companies. And we got revenue, gross profit, net income. Kind of hard to see because we're so skewed. Amazon's such a big company and produces so much revenue, whereas Coupang not as greatly, scaled yet. But we do see growth over here. We can see all three businesses have significant growth coming for the next 5 years. So that is good to see, especially Coupang being on the top end of the three companies there. So then come down here to margins, gross margins, 4%. We know that's probably impacted slightly from the acquisition. Operating margin, probably similar story here, but our profit margin's pretty good, sitting at 6.25%. So we'll have to see how these margins carry through with this new acquisition, see if we can start getting some higher margins coming back in. Obviously, margins right now don't look great, but they have been better in the past prior to the acquisition. And again, free cash flow, we are positive free cash flow. Obviously, we don't produce as much revenue as Amazon and Baba, so that shows us as not looking very good, but we are positive cash flows, which is always a good thing. Return on invested capital, 16%, very good. And a PE ratio currently 32. And between the three companies, we're sitting smack dab in the middle between them. We come down here, earnings yield, we got 3% earnings yield on Coupang, and comparing to the other two, again, sitting somewhere in the middle between the two companies. Now over to the calculator spreadsheet. So now we're going to run these numbers, these valuation, these financials through several different calculators to figure out what Coupang is valued at today based on its current numbers and forecasts. So P/E fair value gives them $27.39. We got a multiples comparison from Amazon to Baba. We're comparing it to those two companies. Gives them $23.98 per share. Price to book ratio, we're looking at 9.6. 5-year average is 12.85. PEG ratio, today we're sitting at a 1.87. And a forward PEG, we're sitting at 2.3. So actually today's PEG is significantly better than forward-looking PEG. So a little backwards there, actually. Typically, you see today's PEG significantly higher than the forward-looking PEG. Grimes valuation gives them $39.26 per share. Company does not provide a dividend, which is good. So we do not have a valuation on that particular calculator. Now, discounted cash flow valuation, there was no analyst growth rate that, I'm sure there's one somewhere, but based on how they've done in the past here, we can see they just consistently get better and better and better, and now are turning into positive free cash flow territory. I'm assuming 15% growth rate on their free cash flows is a respectable number, and I think they can perform and hit that. If they can, we're sitting at $23.14 per share based on a DCF valuation method. Rule 72, 3 sources of an EPS growth rate for an average of 21. We get to then double our current EPS about 3 times. And if we do that down here, we could say our future EPS is 5.6, but I just plugged it in for us just a flat 5. That gives us a fair value of $52.98 per share. Based on the summary of all of our calculators, we get $33.35 per share. 30% margin safety is $23.34. And because of that, we're sitting slightly less than a 30% margin safety. Analysts do have a price target of $23.79 per share. I would slightly have to assume that that's going to increase after the analysts price in for everything, all their changes in Q1, and after earnings have came out, we'll probably see a little bit of some adjustment to that. But for now, that's where analysts are, basically sitting right in line with our 30% margin safety price tag. Now, just because fair value is $33 today doesn't mean the stock's going to $33 in a week. It could take all year. It might never see $33 per share, or it might go to $50 per share. We don't know what it's going to do, but based on the valuation, this is why we try to analyze these stocks and do the best that we can and come up with a number, a fair value number on these companies and figure out. That's why we buy them at 30% margin of safeties. So that way, if we are wrong about our valuation, or if for some reason the market just doesn't think CPNG or Coupang is worth $33 per share, at least we didn't buy in at $33 per share. If it ever got there, we bought in at 23. So we have plenty of margin of safety just in case we are wrong. But over to the stock chart. This is where things get pretty interesting just from a technical standpoint. So company IPO back in March 21, and like most IPOs, you just sell off. No real investors are super interested in them until they start to show financials, revenues, see how things are trending before they want to actually start get serious about buying this business. And now I think is the time when investors are actually starting to see this company as something serious. And we can see that here in the stock chart. We can see volumes have upticked significantly in the last month, actually a couple months here. We can see volumes have increased significantly, and we've finally broken out of this little channel, this range that we've been bound in, about $12 up to like $20, $21 per share. And since even after earnings, we maintained above and held this trend line, depending on where you want to draw it in. This resistance point is now support, and we have now broken trend. And it sure appears as though we are going to start beginning to make higher highs and higher lows. We'll probably zigzag our way back up. And $33 for our fair market value is not that far away. And at $33 per share, there is some junk probably right here, you could say. In this $30 to $32 range, there is a little bit of probably resistance. There's probably where sellers will arise, I would assume. But based on our valuation method, and based on the financials, this thing looks like it's headed for $33 per share. And the technicals are also kind of signaling that we are now breaking out of this channel and beginning to make higher highs and higher lows. But we'll have to wait and see what happens. If that is it for Coupang, if you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.